Today, the spotlight is on banking stocks. Counting in year-on-year terms, public sector banks like IOB, PNB, UCO, Bank of Maharashtra, and even Canara Bank have given between 100 and 160% returns. Even since January, that is year to date, they've given between 35 and 47% returns. And the old favorites, the private sector banks, HDFC Bank has been flat year-on-year, Kotak is down 2%. YOY, but in the past 1 month, HDFC Bank has gained 15% and Kotak 12%. So is the tide turning? Joining me for a status check on banking and NBFC stocks is Suresh Ganapathy of Macquarie. Suresh, thank you very much indeed for your time. So that is the big question. Is it time to start plugging away from PSU banks? If yes, why?
Yeah, sure, Latha. Thanks for having me on your show. Look, I think there are some couple of important developments which are likely to happen over the course of this financial year, right? The Reserve Bank of India itself has very clearly told in their annual report that they want to come out with the ECL guidelines, along with, of course, the project finance guidelines. And also, we are looking at increasing populism. You have seen, obviously, what has happened in the Maharashtra state budget. We're also possibly looking on July 22nd, tentative date when the budget is likely to be presented. There is a positive, and of course, there have been some other states which have announced farm loan waivers. Not that I'm expecting the center to announce one, but then we are seeing certain elements of populism emerging. And at the same time, we are also done and dusted with the fact that the low levels of credit costs are done. And we are likely to see, at least to begin with, the second half slightly lower recovery environment. So if I were to combine all these pieces of the puzzle together, it clearly means that we're looking at a much more normalized credit cost outlook. In fact, the ECL norms will have a greater impact on the public sector banks. And therefore, we do believe it's a high time that the kind of massive outperformance that we've seen in the PSU banks, beginning to get reversed. And today, the private sector banks, after the long periods of underperformance, are at extremely tempting valuation levels with very stable return metrics. And mind you, these are very quality, stable banks. And therefore, I think it's high time that we shift our portfolio a bit more towards private.
Okay. Well, just a word. We did see this news coming from Maharashtra, which was a bit troubling, that banks cannot even demand CIBIL scores from banks. There was a very aggressive political voice against it. But then the same priority sector norms apply to private sector banks as well. Wouldn't that be a sectoral worry?
Yeah, so that's a good question. You ask, see what exactly happens in case of private sector banks here. If you look at their overall agriculture portfolio itself, they don't really lend much to the small and marginal farmers. Okay, they do have roundabout ways of meeting the priority sector lending requirements. They go through PSLC buyouts, priority sector lending certificates, as we call. Maybe if they fall short, they get RITF bonds. So what exactly happens is that while everybody has to adhere to the priority sector lending norms, the private sector banks obviously have a much better way of managing it. If you look at the NPL levels, which is what we brought out in our report, the NPL levels in the agri space for private sector banks like HDFC and Axis are around about 2 to 3% odd or so, whereas that for SBI is 10%, right? So that clearly goes to show the kind of lending within the agri space the private sector banks do compared to the public sector banks.
Okay. All right. So let me come to the earnings picture itself. After all, the quarter has ended. We should be getting into the result season. Do you think HDFC Bank's problems are over? You are giving a fairly decent 14% growth in their EPS in the current year and 20%, that's big, next year. So it's integration problems behind it. Is it a buy for you?
Yes, it is, of course, a buy. I mean, of course, we have a near-term technical trigger in terms of possibly the MSCI inclusion, which perhaps could happen in August. We have to wait for the June 30th shareholding pattern, which the market is eagerly waiting for. Maybe by the end of this week, we have some clarity on that. That itself can result, as per our internal estimates, about $4 to $5 billion of buying, right? So anyways, leave the technical factors aside. The bigger point or the narrative here is that the expectations are now toned down. People are aware of the fact that loan growth will remain at somewhat subdued levels over the course of next 2 or 3 years. And it's all a function of how well they can take up the margins. So what we are arguing here is that indeed, if they are able to deliver an increase in margins over the course of next 2-3 years, you can get that 14 to 20% EPS growth that we are talking about. And that's where the upside lies in. And the stock is indeed very attractively priced for that 14 to 20% EPS growth that we are predicting for the next couple of years.
Okay. Let me come to the other fellow who has been ignored for the past year, Kotak Bank.
Yeah.
Well, if I remember right, you have an upgrade. But
Yes.
then it is at a tall 2.7 price to book. I mean, compared to its past, that is modest.
Yeah.
But a price to book of 2.7 times is higher than any other bank. And you have only an EPS growth of 7% for them.
Yeah.
So why is Kotak an upgrade?
Yeah, so look, I think, Latha, you're looking at the reported Kotak valuations. Remember, in case of Kotak, the subsidiaries have done exceptionally well over the course of last 12 months, because of a very robust capital market outlook, or rather performance. So what's happened is you have to look at on a core price to book basis. On a core price to book, the same report talks about the fact that Kotak is trading at 1.7 times and not 2.7. So 1.7 is damn cheap, right?
Yeah.
Because a significant proportion of the value is coming from the subsidiaries, which have done very well. There has been a prolonged 4 years underperformance in case of Kotak, and at 1.7 times, it really becomes a very attractive buy, way below the historic averages of 3.5 times, even on a core basis that Kotak used to trade. Now, yes, the EPS growth is a bit weaker, mainly because we are expecting some normalization of margins coming through. But I think the way we look at it is that Kotak will still be an entity which reports a 2% plus ROA. On that basis, you're giving 1.7 times for the core bank is clearly a good entry point in our view, and therefore we upgraded the stock to an outperform.
Okay. No PSU bank at all for your buy, in your buy list?
No, not at all. Latha, if you look at it in this way, SBI itself came out with an initial estimate in the analyst meet where they talked about the fact that under ECL, the overall provisioning obligation will be 300 billion based on their initial estimates, right? That's 8% of the net worth, Latha. So if that is for SBI, you can imagine the kind of numbers which is going to flow through for other PSU banks. That's a very significant impact, I believe, and therefore we would really not be getting into these PSU banks at this point in time.
All right, well, let me come very quickly to the NBFCs because I mean, I can't believe you have a short on Bajaj Finance, the storied Bajaj Finance, and not even very positive on Chola, again storied stock, and you prefer Shriram. Why?
Look, I think I do have a value bias in our recommendation outlook. What we are arguing here is these are the companies which are trading at 4 times plus price to book. I think these are really exceptionally high valuations that the market is awarding. Also, you have to look at in an environment where growth for both of them will slow down, margins will go up, credit costs may slightly inch up, and therefore your overall ROAs and ROEs, everything is looking having a downward bias. And that's why we believe it makes more sense to go for a cheaper valuation name at this point in time, which is also having reasonable ROA, right? We do have a buy on guys like Shriram Finance and also Aditya Birla, where the valuations are reasonable and at the same time the ROA levels are pretty healthy. Though, of course, they are trading at a much lower valuation than BAV. And I also strongly believe, Latha, here is that these multiples don't factor in any probability of any of these large institutions getting converted to a bank.
Yeah.
While that is quite some time away, and we're not telling it's going to happen in the next 12 months, but remember that NBFCs are not size agnostic, right? So at some point in time, that pressure will come in, and you are not going to generate a 5% ROA being a bank, and whereas you're getting 4 times kind of price to book. So it makes every sense to factor that into the valuation.
Yeah, I would assume they will fight it as much as possible, but then we saw HDFC's case, right? Let me quickly come to insurance, and then I have some sector questions for you. Insurance, you only like SBI Life, I believe.
Right.
Why that? I mean, why not LIC? Is this fear of dilution?
No. So I think from an insurance standpoint, Latha, if you look at it from January onwards, we have been a bit negative across the space. SBI Life is more a valuation upgrade and it's less impacted by the IRDA regulatory changes. Look, what has happened here is that the sector had let's put it this way, on a unhealthy high level of margins, right? You're operating at 28-30%, and from there you can only go in one direction, which is down. So the competition in the system is pretty high. In the life insurance space, there is irrational pricing across the board. The regulations have come down heavily. First, you saw the tax changes from the government, then the IRDA surrender value changes. All that means that over the course of next 12 to 18 months, we are going to see margin pressures continuing. And therefore, even though you may have a healthy top line growth of 15 to 17%, your margins will bring down your VNB growth to perhaps single digit levels or low double digit, which is not there in the price. So we do see VNB downgrades happening across the board, and therefore we have a negative view on the insurance.
But surrender value should affect even SBI Life, right? I mean, I think those were rules that were needed. It's about time they came as a consumer. But SBI.
Because SBI has 60% in ULIPs.
Okay.
So if you look at the overall proportion of the par and non-par, SBI Life has the least proportion amongst the 4 or 5 insurance companies that we're talking about, life insurance companies.
Okay. All right. Well, quickly, any of the fintechs, I mean, there are only 2, I guess, which are of import.
Prominence.
But Paytm, PB Fintech, anything?
No, I'm Paytm, the dust has to settle in. I mean, there are still a lot more moving parts with respect to that entity. So we'll have to really wait and watch in terms of what exactly happens in terms of their lending operations being sustainable. PB Fintech, we recently upgraded to a neutral rating, but I think the valuation is now really borderline very high. I mean, it trades at some 60 times FY27 multiple, and I'm not willing to buy at that price. So we really have a valuation concern there. And fintechs as such, we just had a conversation with a couple of fintechs even now, and there is increasing skepticism from the RBI in terms of their unsecured growth, and also from the funders to them, which is the banking system being a little bit more conservative.
Yes.
So they will go in for some kind of a squeezing period over the course of next 6 months.
Oh, yes. We're already seeing some telltale signs over there, though, of course, not with respect to these 2. Just a final question on banking stocks itself. Is there any red flag? I mean, RBI governor also has spoken against this F&O and the fear that personal loans are going there to, fuel the stock market. Is there any concern that this unsecured risk weight increase or anything won't go away? May come back? Any such fears at all?
The good part here is that if you look at even the RBI's FSR and the latest annual report, everything is possibly talking about outcomes being in the direction that RBI wanted to be, right? So if you see loan growth, loans given to NBFCs, the banking system has slowed down. The unsecured loans, the banking system has slowed down. So everything is happening as per what RBI wants. The banks are also trying to have a very tight LDR, right? It's very unlikely that banks will have scope to increase LDR further, especially the kind of dictates that you're receiving from the Reserve Bank of India.
Yep.
So as long as banks are following those basic aspects, I really don't see any further big regulatory changes. But the problem here is clearly compliance and governance, and that's an area of weakness which we are seeing across the board. And whether it comes to IT or customer protection or whatever we are talking about, that's a non-negotiable area for the Reserve Bank of India, and therefore there will be continuing idiosyncratic cases in each bank level where there could be issues which the banks will need to pay complete attention to. Otherwise, you definitely run the risk of attracting the regulatory ire on that.
Oh, yes. Banks have become actually technology companies, so there will be pluses and minuses. But that discussion on Adre. Thank you very much, Suresh. Always a pleasure speaking with you and giving us a bunch of ideas on how to look at the banking space. That's it on this edition of Bazaar. After a break, Chartbusters.